The most important crypto story may not be a new coin.
It may be the most boring asset in finance, Treasury bills. For decades, Treasury bills and money market funds lived inside brokerage accounts, bank portals, and institutional settlement systems. Useful, yes. Fast, not always. Programmable, almost never. Now a new idea is spreading through finance: take short-term government debt, or funds that hold it, and represent ownership as tokens on blockchain rails. That is the basic promise of tokenized treasuries.
Not magic money. Not guaranteed profit. Just a familiar financial asset moving onto faster, more programmable infrastructure. Why does this matter? Because stablecoins showed the world that digital dollars can move across the internet. But stablecoins also raise a second question: what sits behind those dollars? In many cases, the answer is cash, bank deposits, and short-term treasury securities. That means the boring back office of finance is suddenly connected to the most experimental edge of software. Tokenized treasuries take that connection one step further. Instead of only holding a stablecoin, a user, fund, or institution could hold a tokenized claim on a treasury-backed product. That token could move between wallets. It could be used as collateral. It could plug into automated settlement. And, in theory, it could interact with smart contracts without waiting for traditional market hours. This is why the idea is powerful. The internet does not sleep. AI agents do not wait for a bank branch to open. Global companies do not stop needing liquidity on weekends. If finance is becoming software, then the cash-like assets inside finance also need software interfaces. Think about a future trading system. One side holds tokenized stocks, tokenized bonds, or tokenized invoices. The other side needs a cash leg. Stablecoins can fill part of that role. Tokenized deposits can fill part of that role. Tokenized treasury products may become another layer, a way to keep liquidity close to the transaction while still connecting to the traditional dollar system. But this is where the thriller begins. The asset may be boring. The wrapper is not. A tokenized treasury still depends on an issuer, a custodian, legal documents, compliance rules, blockchain security, market liquidity, and operational controls. If a smart contract breaks, the asset is not magically safe. If redemptions freeze, the token can trade differently from what people expected. If access is restricted, then the token may not be as open as the internet around it. So the real question is not whether treasury bills are good or bad. The real question is who controls the new financial operating system. Will tokenized treasuries become quiet plumbing for banks and asset managers? Will they become collateral for AI agents and automated markets? Will they make finance faster, or simply move old gatekeepers onto new rails? The next wave of digital money may not look exciting on the surface. It may look like a short-term government security, wrapped in code, moving at internet speed. And that is exactly why it matters. The future of crypto may be less about replacing Wall Street. It may be about rebuilding the money market underneath it. This video is for education only, and is not financial advice.